So I wanted to take a second to talk about the story that I've seen reported in multiple places now. OptionSellers.com. They blew up the other day when natural gas prices spiked. Turns out they were a management company where they were selling naked options on commodities, natural gas in this case, and they got blown out when there was a spike. Somebody ran the stops. So, excuse me. So now the firm is closed. The CEO recorded this apology video, which is ridiculous. He's so sorry that now all your money's gone, and not only that, but they're actually most, or I don't know about most, but at least some of the people who were in this management firm are, they actually owe a margin back to the broker. So I've seen some, not in this article, but in another article I was reading, there was one where the client lost $400,000 and owes an additional 150. So yeah, that's fun. Uh, so the thing that drives me nuts about this is that they're calling this a hedge fund. I don't know if it actually was a hedge fund or not, but you have to practice risk management in your portfolio, because if you don't, this kind of thing happens. So, I mean, if you're going to be selling naked calls, that's fine. You're making the bet that whatever it is you're trading on, what natural gas or a stock or whatever, is going to stay below the strike price, until expiration or until you're going to get out of the trade. And I've done a lot of those trades myself, and when you put the trade on, you look at the historical volatility and you say, okay, based on what I know, the thing is done in the past, and based on the time frame of this trade, then I'm pretty sure it's going to stay below X, right? And then, you buy a strike that is X or higher. And, so that's just one level, though, of risk management, because as we see, prices change, volatility environments change. So you have to know that. And then going into these kinds of trades, this shouldn't be your only trade. That's just ridiculous. And, if you're going to be in size, you want to be hedging on the other side with either, some long volatility or some corresponding instrument that is going to offset if there's a big move. So like one technique is to sell the naked call at some price and then buy into a triple X or a 2X or a 3X leveraged volatility instrument, so that if that does happen where we have a volatility spike, then the amount you gain on the leveraged volatility long is going to at least partially offset your losses, and in some cases you might even get a gain out of it. So these are just basic things that anybody in these kinds of markets and doing these kinds of trades should know. So this guy at OptionSellers.com, which apparently was just down the road from me a little bit over on the other coast of Florida, had been advertising as, yes, these are aggressive instruments, but we trade them conservatively or some such nonsense like that. So, if you're trading out there, then always keep in mind, risk management, trade management, money management. These are all different things, but they intertwine to make, actually a successful trading career. So anyway, I had to talk about it because, I've seen this so many places now. So that's my thought.